Traditional fashion giants like Nike, Louis Vuitton, and H&M spend hundreds of millions of dollars every single year on global advertising campaigns, celebrity endorsements, and elite runway shows just to predict what you will want to wear 6 months from now. They lease prime billboards in Times Square, pay millions to Hollywood influencers, and hire trend forecasting agencies to guess the cultural mood of the next season. Yet, the world's most dominant clothing empire spends almost $0 on traditional advertising. It has no chief marketing officer, completely bypasses the standard fashion calendar, copies high-end runway trends in real time, and places custom garments onto store shelves in London, New York, and Tokyo in under 15 days. Imagine a retail system so fast that if a celebrity wears a specific leather jacket in Milan on a Monday morning, a near-identical version is being bought by consumers in Madrid less than 2 weeks later. This is the reality of Inditex, the parent company of Zara. For decades, traditional retail economics dictated that maximizing profits required massive upfront manufacturing volumes in low-cost countries, leaving brands stuck with mountains of unsold clothes. Zara completely flipped the script. It built a multi-billion-dollar empire by operating more like an agile data-tracking technology firm than a clothing company. How can a mass-market retail giant achieve this level of hyperspeed without accumulating billions of dollars in dead inventory that routinely destroys rival fashion brands? Welcome to BizBlueprint. Today, we are going to reverse engineer the financial architecture of Inditex, the parent company of Zara. We will dissect its highly unorthodox cost structures, explore its closed-loop supply chain, and uncover the precise mathematical and logistical algorithms that turn human urgency into highly predictable corporate cash flow. To understand the financial genius of Zara, we must first look at the structural graveyard of the traditional apparel industry. For over a century, global fashion operated on a rigid, 4-season linear pipeline: spring, summer, autumn, and winter. Under this legacy framework, a fashion brand begins its design process up to 9 months before the clothes ever hit a retail rack. Designers create sketches, sample fabrics are approved, and production orders for tens of thousands of units are outsourced to low-wage factories across East Asia to achieve economies of scale and minimize the cost per garment. But this long lead time model creates a terrifying financial vulnerability: the forecasting risk. The brand is essentially gambling hundreds of millions of dollars of upfront capital on a statistical guess. If a sudden shift in consumer taste occurs, if the weather is unexpectedly warm in November, or if a competitor launches a viral alternative, the traditional retailer is trapped. They are stuck with millions of units of dead inventory sitting in warehouses across the globe. To clear this shelf space and salvage cash flow, they are forced to launch aggressive liquidation sales, slashing prices by 40, 50, or even 70%. This destructive markdown cycle systematically erodes the brand's net profit margins, destroys brand equity, and burns through working capital. In the late 1970s, a Spanish businessman named Amancio Ortega realized that this entire industry structure was fundamentally broken. He asked a simple, revolutionary question. What if, instead of pushing pre-designed clothes onto a passive consumer, we built a reactive system that pulls data directly from the cash register to manufacture exactly what people are buying right now? This was the birth of fast fashion. Ortega didn't view Zara as a creative design house. He viewed it as a fulfillment processor. Today, Inditex is a global monolith generating over $35 billion in annual revenue, operating thousands of stores across more than 90 markets. But maintaining a hyper-agile system that updates its inventory twice every single week requires a complete redesign of the traditional corporate balance sheet. To understand how this machine functions, we must look into the first pillar of its economic blueprint: capital expenditure, or CapEx. In traditional retail economics, capital expenditure is heavily weighted toward outward-facing metrics. Brands deploy their CapEx to buy primetime television slots, acquire digital ad inventory on Meta and Google, and fund massive promotional rollouts. Zara completely eliminates this entire expenditure category. Because Zara does not run traditional ad campaigns, their marketing CapEx is zero. Instead, their capital is aggressively weaponized into two highly strategic internal asset classes: ultra-premium flagship real estate and automated proprietary logistics infrastructure. Let us look first at their real estate acquisition strategy. Zara uses its CapEx to turn physical storefronts into its primary marketing vehicle. The company spends billions of dollars securing or leasing iconic historical real estate in the world's most expensive shopping districts. We are talking about Fifth Avenue in New York, Regent Street in London, the Champs-Élysées in Paris, and Shibuya in Tokyo. Zara's real estate algorithm dictates a strict rule. Their storefronts must be located immediately adjacent to ultra-luxury fashion houses like Gucci, Prada, Chanel, and Louis Vuitton. By deliberately positioning a mass-market store next to a high-end luxury boutique, Zara executes a brilliant psychological positioning trick. In the mind of the consumer, the brand perception of Zara is artificially elevated. The shopper subconsciously associates Zara with luxury design. But when they step inside, they realize the price point is comparable to a standard department store. The physical building acts as the billboard. The premium rent is not just an operational real estate cost. It is a calculated marketing CapEx investment that generates massive organic foot traffic without spending a single dollar on an ad agency. However, the true crown jewel of Zara's capital expenditure is hidden far away from the glamorous shopping streets of Manhattan or Paris. It is located in the small industrial town of Arteixo in northern Spain. This is Inditex's global headquarters, a massive 5 million square foot technological and logistical nerve center. The company has poured billions of dollars of CapEx into building an automated infrastructure that rivals the fulfillment capabilities of Amazon. At the center of this facility sits a multi-million-dollar automated sorting matrix, connected to over 200 kilometers of subterranean tracking rails. Every single Zara store worldwide is linked directly to this central facility via a proprietary software network. Zara's store managers do not use standard retail inventory software. They are equipped with custom-designed handheld digital devices that track granular consumer interactions. When a customer walks into a store in London, picks up a green dress, tries it on, but leaves it in the changing room because the zipper is uncomfortable, that qualitative data point is logged by the staff and transmitted directly to the servers in Spain. When a specific size sells out in a Tokyo store on a Tuesday morning, the automated checkout system logs the transaction and instantly pings the Spanish distribution hub to prepare a replacement batch. Zara's CapEx didn't build a clothing supply chain. It built a high-frequency data processor that treats garments like digital information packets. In classic retail economics, the absolute holy grail of cost reduction is minimizing labor expenses. For decades, multi-billion-dollar apparel conglomerates like H&M, Gap, and Nike have structured their entire operational pipelines around a single strategy: outsourcing. They move 100% of their garment manufacturing to developing countries with low labor costs. Under this traditional framework, raw materials are shipped to factories, assembled by low-wage workers, and then placed onto massive cargo container ships. However, this hyper-outsourced model exposes brands to a massive operational vulnerability: time. It takes anywhere from 6 to 9 months for an item manufactured in Asia to clear customs and arrive at a retail distribution hub in Europe or North America. The brand pays a very low cost per garment, but they sacrifice all operational flexibility. They are structurally blind to real-time market shifts. Zara completely shatters this economic dogma. They willingly accept a significantly higher daily operational expenditure, or OpEx, by deploying a strategy known as nearshoring. Instead of chasing the cheapest labor pool on Earth, Zara manufactures roughly 50% of its products in highly developed, capital-intensive regions close to its primary European markets, specifically mainland Spain, Portugal, Morocco, and Turkey. From a spreadsheet perspective, this looks like operational madness. The wages paid to a garment worker in Portugal or Spain are up to 3 to 5 times higher than those paid to a worker in a developing market. This choice dramatically inflates Zara's manufacturing OpEx per unit. But what Zara is actually doing on its balance sheet is a highly calculated trade-off. They are spending money on premium labor to purchase the ultimate business commodity, speed and agility. By keeping manufacturing localized, Zara eliminates the 9-month shipping delay. A designer in Artega can spot a trending leather jacket on Instagram on a Monday morning, send the digital file to an automated cutting laser in a nearby Spanish factory on Tuesday, have it stitched by a local cooperative by Friday, and possess a finished, retail-ready product shipped to a store in Paris by the following Wednesday. Zara treats proximity as a premium operational asset that completely offsets their higher labor costs. The remaining 50% of Zara's inventory, consisting of basic, non-trending items like plain white t-shirts and staple denim, is still outsourced to low-cost Asian factories. Because these basic styles do not change based on rapid cultural trends, Zara can afford the long lead times, balancing their overall OpEx profile. However, Zara's localized operational machine requires a highly synchronized logistics velocity. This brings us to their transportation OpEx. Zara's entire distribution model is built around a high-frequency delivery window. Every single Zara store worldwide receives customized shipments exactly twice a week, without exception. To meet this rigid schedule, the company maintains permanent, round-the-clock air freight contracts with major global cargo carriers. When the automated sorting racks in Spain pack a customized order for a store in Tokyo, the clothes are immediately driven to an airport, flown commercial cargo across continents, and unpacked on the Tokyo retail floor within 48 hours of leaving the factory warehouse. The clothing is shipped on hangers, with price tags and security labels already attached by automated machines in Spain, meaning store staff spend zero time processing inventory in back rooms. The clothes go directly from the delivery truck straight onto the display rack. This extreme transport speed requires massive premium shipping OpEx, but it ensures that Zara's capital is never trapped in stagnant, slow-moving maritime shipping containers. With labor and logistics costs pushed far above the industry average, how does the Zara financial model turn a massive profit? The answer lies in their brilliant manipulation of consumer psychology and revenue engineering. Zara generates billions of dollars in cash by mastering a concept known as artificial scarcity. Traditional apparel retailers operate on a volume-driven revenue model. They order 50,000 units of a single trending dress, display it prominently on the store floor, and leave it there for 2 to 3 months. If you walk into a traditional clothing store, see a shirt you like, but decide not to buy it, you know with absolute certainty that you can return 2 weeks later and find that exact same shirt in your size. There is no urgency. The consumer has all the time in the world to wait for a discount or a promotional holiday sale. Zara completely destroys this consumer comfort zone. They manufacture items in incredibly small batches, intentionally undersupplying the market. If a new floral dress style sells out in London on a Tuesday afternoon, Zara's data system does not issue a reorder for that exact same dress. Instead, the design team instantly tweaks the pattern, changes the sleeve style or color hue, and ships a completely new alternative version by Friday morning. This creates an intense subconscious psychological trigger in the mind of the consumer, the fear of missing out. When a shopper sees a unique jacket on a Zara rack, they know that if they do not buy it at that exact fraction of a second, it will be gone forever. There is no safety net. This artificial scarcity engine completely alters the metrics of customer retention and foot traffic frequency. In the global retail industry, the average consumer walks into a standard clothing store roughly 4 times a year. They shop during seasonal shifts or major holiday sales. For Zara, the numbers are astronomical. The average Zara customer walks into a physical storefront up to 17 times a year. Because the inventory is completely refreshed twice every single week, the store experience is never the same twice. Zara has successfully transformed clothes shopping from an occasional chore into a high-frequency hobby. More importantly, this urgency engine insulates Zara's revenue streams from the most destructive force in retail, the markdown cycle. Because items are produced in tiny batches and sell out rapidly at full retail price, Zara rarely has to liquidate dead stock. While traditional fashion houses are forced to slash prices on up to 40% of their entire inventory every season just to clear warehouse space, Zara sells an unprecedented 85% of its clothing at full, non-discounted retail price. By turning their inventory over at hyperspeed, Zara bypasses the traditional discount trap, converting consumer impulse buys into an aggressive, highly predictable, cash-generative revenue engine. We have dissected the infrastructure, the logistical velocity, and the revenue engines. Now we arrive at the final, cold reality of Zara's financial blueprint: the margin profile and the brutal math of the break-even point. In standard retail, a company's net profit margin is the ultimate report card. Most apparel retailers are ecstatic if they can maintain a net profit margin of 5 to 7%. Zara consistently defies this gravity, maintaining a net profit margin that fluctuates between 10 and 12%. How do they achieve this performance while simultaneously carrying the burden of expensive nearshore manufacturing and premium global real estate? The secret is the extreme minimization of inventory risk. In the retail world, inventory is a depreciating asset. A garment sitting on a shelf for 3 months is not just taking up space, it is losing value every single second. Traditional retailers fail because they have huge quantities of inventory sitting idle. Zara succeeds because their inventory is always in motion. By producing in tiny batches and refreshing stock twice a week, Zara ensures that their capital is never tied up in dead stock that requires heavy discounting. When you remove the need for massive clearance sales, you protect your gross margins. While a competitor like Gap or H&M might be forced to mark down 40% of their inventory to clear shelf space, Zara's markdown rate sits at a microscopic fraction of that figure. This allows Zara to maintain a healthy gross margin of 55 to 60%, even after accounting for the higher costs of localized European labor. However, Zara's model is not an invincible fortress. It is a high-speed machine that requires perfect equilibrium. To reach their break-even point, Zara does not need massive, long-term sales volume on a single item. They need absolute consistency in turnover. If a store's inventory turnover velocity drops, the high fixed costs of their premium storefronts and their expensive air freight logistics will immediately cannibalize their margins. The primary financial risk hanging over Zara's head today is not a shift in fashion trends, but a tectonic shift in the macroeconomic landscape. For the last decade, Zara's speed-based moat has been their greatest defense. But the rise of ultra-fast, digital-native competitors like Shein and Temu has introduced a new variable: the algorithmic pricing war. These digital giants are using AI-driven manufacturing and direct-to-consumer shipping that is even faster and significantly cheaper than Zara's nearshore physical model. While Zara uses prime real estate to build brand value, these digital platforms use massive social media marketing spend to bypass the retail store entirely. If global consumers continue to pivot toward ultra-cheap online-only apparel, Zara will face a massive strategic dilemma. Should they abandon their premium real estate strategy to compete on price, or should they double down on their brand experience to justify a higher price point? This is the fundamental challenge of the current retail era. The faster you move, the harder it is to maintain the premium brand positioning that allows you to charge full price. The economic blueprint of Zara exposes the ultimate triumph of data-driven logistics over traditional creative guesswork. Zara did not build a business based on predicting what the world wants to wear. They built a financial processor designed to react with surgical precision to what the world is buying at this very second. They stripped away the vanity of expensive fashion marketing and replaced it with an automated, high-frequency, localized supply chain that monetizes human urgency. They built a beautiful clothing brand on the outside, but underneath the fabric and thread, it is a flawless, high-speed logistics machine designed to systematically extract wealth from the global consumer through one simple, brilliant trick. They made fashion an event that is happening right now or gone forever. How often do you find yourself shopping at fast fashion retailers? And do you think their high-speed, localized manufacturing model can continue to survive in a future dominated by ultra-cheap, digital-only global competitors? Do you value the brand experience of a physical store, or is price the only thing that matters in the modern era? Let us know your thoughts in the comments below. Do not forget to hit like, subscribe, and turn on the notification bell so you never miss the next corporate breakdown from BizBlueprint. We are committed to dissecting the real mechanics of the world's most complex business machines. Thank you for watching, and see you next time.